Welcome to The Explainer. Today, we're diving into a genuinely fascinating blueprint for long-term wealth creation. We're talking about building a massive corporate empire literally from scratch. And hey, we aren't talking about inventing the next big app in your garage either. No, we're talking about acquiring existing cash-flowing businesses and stacking them into a self-sustaining holding company. It's this brilliant, proven strategy that takes everyday operators and turns them into actual empire builders. Okay, let's dive into this.
Right now, we are standing right at the edge of what economists like to call the silver tsunami. Over the next 2 decades, millions of small businesses owned by baby boomers are going to change hands as those founders retire. Think about this. We are talking about roughly $10 trillion in assets. I'm talking plumbing companies, HVAC businesses, specialized manufacturers, accounting firms, the whole shebang. This represents a historic wealth creation opportunity for anyone who knows how to step in, acquire those assets, and optimize them. Now, most people automatically associate wealth creation with traditional startups, right? You have an idea, you build a product, and you essentially gamble on finding an audience. But let's be totally honest here. That path comes with a massive failure rate, and you're usually spending months, if not years, in a zero revenue reality. Entrepreneurship through acquisition completely flips the script. Instead of starting from zero, you just buy an existing business. The ultimate game changer here is day one cash flow. You're stepping into an asset that already has a proven product market fit, and more importantly, an existing paying customer base. Section 1. Finding and funding deals. When we look at entrepreneurship through acquisition, or ETA for short, we generally see 2 main paths. You can do a self-funded search, leveraging your own capital and loans to buy a business, or you can go with a search fund, where investors actually back you to find and run a larger company. But actually sourcing these deals, well, that requires a deep understanding of owner psychology. Whether you're browsing broker listings or sending cold outreach directly to owners, you have to remember that this is deeply personal. You aren't just buying a B2B spreadsheet, you're buying someone's life's work. Navigating those emotions is absolutely key to getting a deal done. So that brings us to the actual buying timeline. First, you source the deal. Once you agree on a basic price, you sign a letter of intent, or LOI. And that kicks off step 3, which is due diligence. This is where the rose-colored glasses come off, for sure. Beginners often make fatal mistakes here, failing to verify financial health or uncovering hidden liabilities. It is an exhausting, rigorous phase, which is exactly why the vast majority of business listings never actually cross the finish line. But if the business survives due diligence, you move to closing. Here, you'll decide whether you're buying the corporate entity itself in a stock purchase or just its equipment and customer lists in an asset purchase. Now, before we look at the hard numbers, you're going to hear the term capital stack thrown around a lot in this space. But looking at it simply, it's really just the layered mix of debt, like bank loans, and equity, meaning cash from you or your investors, used to fund a purchase. Think of it kind of like a layered cake that pays the seller so you can finally take the keys. And this brilliantly illustrates how it works in practice. Let's look at a hypothetical $1 million acquisition. In the United States, utilizing an SBA loan or a similar government-backed bank loan if you're elsewhere, you might finance a massive 80% of the deal with bank debt. Another 10% might be seller financing, where the retiring owner basically acts as the bank and lets you pay them over time. That leaves just 10%, or $100,000, in buyer equity required from you and any partners. Now, this structure limits your upfront cash, which is great, but let's be frank. Taking on an $800,000 loan often requires a personal guarantee. The anxiety of tying your personal assets to the success of the business, that's the very real price of admission. Section 2, taking over the operations. Once the ink is dry, the thrill of the purchase kind of fades and the real work begins. You're no longer just a deal maker, you're an operator. Your immediate operational priorities are critical right now. First and foremost, you're going to need incredibly high emotional intelligence. The employees will be nervous, naturally, and winning their trust is paramount to retaining your customers. Simultaneously, you've got to tightly manage cash flow to service that new debt and establish clear key performance indicators. Remember, the goal here isn't to buy yourself a grueling 80-hour-a-week job. You're stepping in to build robust operational systems, hire exceptional management, and eventually delegate leadership so the business can just run without you. Section 3. The magic of compounding. As we look at scaling, everything anchors back to EBITDA, earnings before interest, taxes, depreciation, and amortization. As a standard measure of a company's pure cash-generating power, this is basically the foundational metric we use to determine the enterprise value of the assets we're acquiring. So when we evaluate businesses to buy, we always value them as a multiple of their EBITDA. The ultimate unlock here is multiple arbitrage, and man, it's where the real wealth generation magic happens. So the crucial point is this: small businesses are inherently riskier than large businesses, so they naturally sell for lower EBITDA multiples. But if you buy several small, related companies at lower multiples and combine them into one larger, safer, dominant entity, the market suddenly values that new, combined entity at a much higher multiple. When you take the cash flow from your first business and reinvest it into acquiring a second and then a third, you are exponentially growing your wealth through this arbitrage. Let's think about the math here. A standalone $1 million small business might trade at a 3x multiple. But if you aggregate 5 of those businesses together into a holding company, that larger, diversified entity might command an 8x multiple, or even higher in the open market. This really drives home the staggering difference between building an empire and merely operating a mom-and-pop shop. You aren't just grinding out organic growth by a few percentage points a year. You are literally engineering a higher valuation overnight simply by gaining scale. Section 4. Building your forever empire. This brings us to the ultimate structure, the holding company. Now, a holding company doesn't produce goods or services itself. It's just a parent corporation whose sole purpose is to own controlling stock in other operating companies. This is the exact structure Warren Buffett used to build Berkshire Hathaway, and it's the very model Constellation Software uses to absolutely dominate the vertical market software space. History completely proves that when structured correctly, holding companies become spectacularly valuable compounding machines. So, how do you actually run the empire? Well, you typically form a management layer above all the individual businesses. The secret to efficiency here comes down to capital allocation and shared services. You quickly centralize all the expensive, redundant back-office stuff, like HR, IT, and accounting, up at the holding company level. But, and this is critical, you strictly decentralize the daily operations. You have to empower your local managers to run their specific businesses without top-down bureaucracy slowing them down. At the top level, your job transitions purely into managing portfolio governance and optimizing debt across the whole empire. And speaking of optimizing debt, I absolutely have to share one of the most brilliant financial tools available to a holding company: dividend recapitalization. Honestly, a dividend recap almost feels like a financial cheat code. As your acquired businesses grow and pay down their initial loans, they build equity. What you can do is take out a new loan against that increased value and use those funds to pay a massive cash dividend to yourself and your investors. You literally pull your original capital out tax-deferred, and the craziest part, you actually still own the underlying cash-flowing asset. This reveals a fundamental paradigm shift. You see, a lot of private equity firms are totally obsessed with flipping businesses, buying them, trimming the costs, and selling them 3 years later. But flipping is a short-term game that triggers massive tax events and requires constant, high-effort transaction hunting. Conversely, building a holding company allows you to adopt a holding forever mindset. This allows your wealth to compound tax-efficiently over decades, creating a completely unstoppable financial engine and a genuine family legacy. The opportunity cost of impatience is just way too high.
There's a very good reason Warren Buffett famously said, "Our favorite holding period is forever." An infinite holding period harnesses the eighth wonder of the world: compound interest. Patience, when coupled with disciplined capital allocation over decades, will always beat the frantic, short-term transactional thinking of business flippers. Remember, you aren't just trading assets, you're collecting great businesses and letting time do the heavy lifting for you. As we wrap up this explainer, I want to leave you with a thought to really chew on. When you look at the millions of businesses about to transition in the coming years, how are you going to approach the opportunity? Are you looking to build a business just to endure the stress of selling it a few years down the line? Or are you ready to use these exact tools, ETA, smart financing, and holding company structures, to build a lasting legacy you can hold forever? The playbook is right in front of you. Now, it's time to build.